Real estate has long been known as New York City's essential industry, as oil is to Texas or tech to Silicon Valley. But just how essential is real estate to New York? Real estate-related taxes contribute nearly 50% of the city's total tax receipts annually. In 2011, the property tax alone will generate $17.6 billion. That's more than personal income tax, sales tax, and general corporation tax combined. While other tax sources tend to fluctuate with the economy, the real property tax is a stable, steady source of city revenue. This revenue has been vital to New York's economic growth. Since 2001, the proceeds of the real property tax have increased 100%, while personal income tax and sales tax have grown 31%. Clearly, the real property tax is critical for the city's economic health. However, there are some strings attached. The real property tax is the most complicated tax to understand, the most inequitable in its assessment of tax liability, and a major impediment to economic growth and capital investment.
The city has 4 classes of real property. Class 1 is made up of 1, 2, and 3 family homes for the most part. Class 2 is rental properties plus co-ops and condos. Then there's Class 3, which is all of the utility property in the city. And then Class 4 is everything else. So that's everything from office buildings to small retail stores to department stores to gas stations, garages, parking lots. In Class 1, the city has a target of bringing the assessed value for each property up to 6% of its market value. In Class 2, for the 11 and more unit buildings, the city uses an assessment of 45% of market value. In Class 3 and Class 4, it's 45% across the board for all properties. So there, the assessment is equal to 45% of whatever the city has determined the market value to be.
One of the most important things very few people understand is how unfair the property tax system is in New York. Residential property accounts for about 50% of the market value of all the property in the city and pays 15% of the tax, which means the other 50%, primarily commercial office buildings, but industrial facilities, utilities, pay 85% of the tax. We have created a tax system which puts most of the burden on commercial office buildings. That's why taxes, property taxes, are such a huge percentage of the cost of rent for tenants in New York.
New York City's property tax is very significant. 20% of gross rent goes to real estate taxes, compared to other cities around the country, for instance, San Francisco, which is only 12%. In New York City Midtown, real estate taxes are $18 a foot. In New Jersey, they're $4.50, and in Stamford, they're $5. That already, obviously, is significantly more than the surrounding cities. New York needs to do better in balancing the taxes and where it comes from among the class of properties in real estate.
The tax burden in New York City on rental housing is much greater than it is in any jurisdiction that I've ever seen. We had properties in Phoenix, and we compared them directly to New York City properties, and there is no comparison.
The only part of the residential properties mix that we haven't done anything for are rental buildings, which are now paying very high property taxes, especially compared with anyone else. There's this great example in the ritziest part of Fifth Avenue. 800 Fifth Avenue is a rental building. 820 Fifth Avenue is a co-op building. 800 pays twice the real estate tax of 820. What fairness is that? None.
New office development today is very costly, as it would be in any city, particularly in New York City, where real estate taxes can be $25 a square foot. When you add to that the cost of constructing an office building, developers must get in excess of $100 a foot. The market has not been there to achieve those kinds of rents. And new development is really needed to keep New York City very competitive.
If the city's tax system isn't brought back down to earth in one way, shape, or manner, rental housing will begin to disappear. People will move on. Investors will take their money and find a different investment to put it in. Builders will have to build where the investment money goes. The only rental housing you can build in Manhattan has to be financed by the 80-20 program, where 80% of the apartments are market rate housing and 20% are low-income housing. It's a terrific program. The problem is, those are the buildings that are showing the highest assessments. And not only will we lose the new market rental stock, we will lose the 20% low-income housing stock that's being generated along with the market rate housing. If those taxes stay, or those assessments stay at a number that's going to produce 35% of your gross income going to the city of New York, no one will build them anymore.
The growing tax burden on real estate to pay a larger share of the city's budget is unsustainable. More importantly, this growing burden has fallen disproportionately on the city's income-producing properties. In the last decade, our real property tax has increased 100%, and the city's budget has grown 66%. For New York to remain competitive with the world's 21st century cities, Shanghai, Sydney, Sao Paulo, and others, we must rethink and restructure our property tax system. In today's hyper-competitive, hyper-connected global business environment, there is no margin for delay. The time to act is now.